Hello, we're joined today by Rosslyn Data Technologies, who have just announced their full year results. So thank you for coming in, Roger.
My pleasure.
Now, you're a new client of equity development, so perhaps we could begin by giving the viewers a little bit of an overview of what it is that Rosslyn do.
Yeah, so Rosslyn Data Technologies formed a few years ago, and we are experts in data technology, as you can tell by the name. We extract data from our clients' many sources, whether they be ERP, structured or unstructured data. We aggregate that data, put it all together, and very often, for the first time, give a client a holistic view of their data. We then cleanse that data, enrich it, and play it back to them in either a data mining application or a visualization tool with access to data that they've never seen before. And really, we've made that data very actionable and given insights that the client can actually drive from it.
Understanding what you do in a brief interview is probably asking a little much, but to give people some comfort, give us a name of some of your big clients then.
Our clients, they tend to be multinational clients, ranging from Heineken, the KLMs of this world, Diageo, big ticket items that people know around the globe.
And what are your routes to market to reach these individuals?
Predominantly we're a direct sales force, but we also have a partner team, and we sell through some of our partner relationships, either by referral or through the partner actually operating as a value-added reseller.
Now, one of the attractions of the business is that from the beginning of the year you already have a strong contracted base. What size is that sitting at, and is that growing?
Yeah, the contracted base runs at around £5 and a bit million at the start of the year, and it is growing. It's growing in line with our annual growth rate, which is around 8%, and we expect that to continue. As times go on, the contracts are getting larger and larger, so we're increasing that ARR stream that we have in the backlog.
And as a percentage of your revenue, then, what is that 5.5 coming in at?
It represents between 65 and 75%, and it really depends on which contract we're looking at. But overall, 70% is about the right number that I'd have in my mind. That's where our ARR sits. So
you mentioned there about moving into larger contracts. There was a mention, I think, in the statement about a land and expand strategy as you look to penetrate clients a little more deeply. Perhaps we could give people a sense of what market share there still is out there to be achieved from your existing client base without even having to make any new wins.
That's quite a difficult question to answer, because what we're doing is we're looking at our clients from a different perspective and looking at their complete supply chain and where our technology can be used to enhance the offering and the value that we can create for our clients. So some of our new products, such as the supplier onboarding, our supplier information management systems, all applications that sit on top of the Rapid platform, the platform that is our underlying core business, that actually is giving us probably 3 to 5 times the opportunity with our clients. But the aim really is to make us very sticky with our clients, that they stay with us for a long time and that we don't suffer a lot of churn in the future. Not that we've suffered churn in the past. Our churn rate is very low, between 5 and 7%. But I'd like that to be even lower still, and clients see us as an integral part of their solutions and their data management going forward.
Perhaps I can phrase it another way then. Are you seeing these average contract values increasing over time with your existing client base?
The average contract value is growing. There's no doubt about that. Whether it's actually with our current client base or whether it's our new clients, as we are going in and expanding and selling a product that is far greater. I think we're seeing more success in dealing with the new clients and growing that average contract value than the land and expand strategy. The land and expand strategy is always an add-on sale to it. And whereas, yes, we can increase the revenue, with a new client we're able to increase that more significantly because we can demonstrate the value as a whole rather than in piecemeal process.
Okay. In which case then, can you give us some sense of the new client wins in the period and any particular that you want to pull out?
Yeah, some of them obviously, some of them are very secretive about the names, but the average contract value, if I go back to that point, has increased over the last 3 years from around £50,000 per annum to £80,000 per annum, and most of our new contracts we're touching the 100,000 plus per annum, and it's very rare for us to sign a contract that's below the £60,000 mark, which is good news for us. Some of the new contracts we're signing, we're very successful in the transport and the logistics world, and currently we're also looking at handling other things outside, slightly to the adjacent of the supply chain, things like raw material delivery and logistics. Those sort of things are expanding our offering.
These are things that you can accommodate within the existing Rapid platform without any additional acquisitions.
The technology doesn't care what data it is. We need to build a schema that operates to the client's requirements, and we use the same engine for cleaning and enriching. Once you've got the data out of the ERP systems and out of the data sources, the schema and the operating model and the data operating model, the visualization are all the same engine. But that data lifecycle management is the key driver. Once we fully understood that, we can actually deliver an enormous amount of value to our clients.
So given that there is some uniformity to these data sets, then, does this mean implementation times are coming down?
Depends on the complexity. If we have a very simple 5-10 ERP system or other data sources, yes, the answer is yes to that question. When we have clients who are looking at 50, 60 different ERP systems or different data sources, then it's a very complex and very challenging environment that we have to operate in. And yes, we can deliver that in a very rapid, pardon the pun on our name, time frame. It's very much dependent on the client's availability of their resources to enable us to implement that in a timely fashion.
But able to do it within the existing Rapid platform without too many tweaks, i.e. not impacting on your gross margin.
I don't like tweaks. I mean, my view is the clients, if we get the structure right, we can get the data. It is all about that data operating model. If we understand the data operating model right from the outset, and that's hard for a client to come to the table with, because our data experts really know where we're looking and what we need. If we can build the extraction methodology to give us exactly the right data, we can see the outputs that the client wants so that we can make sure that that data is available to provide the outputs, then we can implement very, very quickly. If we don't have that, it takes time because we're reiterating and we're repeating the work. More often than not, we manage to make all of our deadlines. Where we don't, it tends to be because of info security within our clients being very precious. It is one of the biggest delays we suffer at this moment in time. And as much as we try to get over that as fast as we can, there's a lot of testing that clients have to do, and it needs resources from the client. But we do deliver on time and on budget.
Good to hear. Now, there was one other comment in the statement that I wanted to pick up on. Obviously, you saw a couple of large contracts slip into the next period that hadn't been signed for the reporting period we're discussing. Now, given that you've got large clients already on your roster, Diageo, BAE, are these clients, how big do we get, and why is the the signing time taking quite so long?
The size of the clients is, they are global operators, and they tend to be in the either the top Fortune 100, or some of them are in the Fortune 10. And we're very fortunate and very grateful to those clients for considering Rosslyn, but we do think we offer one of the best products out there in the market. Why is it taking us longer? There are more stakeholders now. The bigger you get with a client, the more stakeholders you have to convince, and the more levels of compliance and security you have to go through. And data security is key for everybody. We make sure that our security levels are at the highest standard. We operate on FedRAMP compliant and Home Office security levels to make sure that our data is fully protected. That causes delays. We overcome them as quickly as we can. We make sure that we get our clients focused and understand that in order for us to get to deliver on time, They need to get their ducks in a row at the same time as we're doing everything that we can.
Lots of good news there. Thank you, Roger.
You're welcome. Thank you.
Thanks for joining us, Ash. Only 5 months into your term at Rosslyn. So perhaps just as a brief overview, what attracted you to join the business?
Well, for me, it's a combination of things. Primarily being in a company which is in a really exciting sector in big data, and also a sector aligned to something that I know something about, having worked in large multinationals and the complexity of procurement in large companies. And then, of course, another factor was the management team and the CEO and the chairman and the whole of the management team, which has a wide variety of sort of skills and experience. And so far it's going well. A
big opportunity to join. So perhaps then talk us through gross margin, obviously been some positive moves there. Can you give us a little bit of sense of what's behind that?
Yeah, sure. We spent a lot of time looking at our cloud storage costs. So obviously we use Azure to deliver services to our clients. Now, the large part of that cost is storage and processing, and we've worked with Microsoft to basically work more efficiently with our resources in the cloud, and that's brought our costs down, and that then obviously has an impact on improving our margin. And that's something which we've pretty much finished the work on, but we could still see further downward trend on those costs, and perhaps gross margin moving up from the current 80 to 81%, moving up to perhaps 82, 83, 84% in future.
Okay, so very sustainable in the terms of the direction of travel. What about things like, I don't know, costs on sales and marketing and so on? Are these not going to need to ramp up as the business expands?
Yes, they are. So 2 years after buying Integrity, we fully integrated that acquisition, and that has led to some very significant synergies from the two companies. And so, for example, in the last year, we reduced our OPEX from 6.9 million to 6 million. And we think that's a pretty stable baseline, and that has then allowed us, with the revenues from Integrity, to move to a situation where we're almost break even in terms of EBITDA. So we're now using EBITDA as a key metric for ourselves. And so where we do make further investment, it will only be done alongside growth in revenue. And so having got to the point of reaching EBITDA neutral, we don't want to go backwards again. So we will invest, and the main area we will be investing is in sales and marketing. We continue to make further efficiencies in our development processes, and so we'll continue to look at that, and that will mean us shifting headcount from development and support into sales and marketing.
And we've seen obviously a very positive move in operating cash flow as you move towards profitability, but obviously not quite there yet. Can you just remind us what facilities you've got in place to continue to support growth?
Yeah, that's right. So at the moment we have a 1.5 million term loan facility with Clydesdale. We've drawn down 1 million of that, and we will draw down the other 500,000 in the next few months. We are operating broadly at an EBITDA neutral, so the cash burn is minimal. We don't have a lot of capex, and in terms of cash balances, what will also help us is our continued investment into R&D. So we invest around 1 million to 1.1 million in R&D, and most of that expenditure qualifies for R&D tax credits. So we do see, I think as explained in the results, a tax credit repayment of around 360,000 coming in. So that's something we will continue in future years as well.
And as a global business, have you got any exposure to currency volatilities?
Not a great deal. So of our revenues, the large part are in sterling. We have some revenues in euros and we have some revenues in dollars, but those are fairly minimal. So the current volatility in currency rates hasn't impacted us greatly in our P&L. And as far as our balance sheet goes, then we have operations in the US, but those largely wash their face, so they're broadly neutral in terms of revenue terms, revenue and profit. And also we don't have many assets in the US. So our exposure mainly is sterling denominated.
Thank you, Ash. Very helpful.
Thank you, Anna.
Okay, Roger, then. Well, as we look towards the future, obviously acquisitions are another way in which to build the business. You've got the supply chain in place. You're looking to supplement it with some logistics, supplier lifecycle management?
Well, we're considering adjacent technologies, and revenue that's demonstrated or comes from exactly the same sort of flow that we're currently attacking. I think that we have to keep our eyes open and keep a broad mind. Ideally, I want the profit-making, high revenue at a very low cost acquisition, as I think everybody does.
You and everyone.
And I'll never concede that there aren't those companies out there, so we will keep looking for those. But we're looking for technologies that are adjacent to and delivering into the supply chain. But we're also looking for revenue streams that can actually, I'll use the term lift and shift, that can be moved onto the Rapid platform, either from an on-premise solution or another cloud-based platform that enable us to maximise the use of our technology, maximise the use of our experience with data, and lower the cost base of delivery. So we're open to options that are out there, and we're keeping our minds, keeping that field very wide.
Excellent. And obviously the business is moving in the right direction in terms of cash and profitability. Any other bumps on the horizon that you see?
I'm very pleased with the movement that we had to, the improvement on profits in the last year. It has been led, very much by looking at our cost base, making sure that we're getting the right value from our investments we're making. We're also continuing to making investments into our R&D. New products are coming out, new solutions are coming out, new visualizations are coming out. So we're doing a lot of things that are right and pushing us in the right direction. Our sales efforts need to be pushed forward, and we're carrying on doing that. Our marketing needs a bit more investment, and we'll look to do that from our operating cash flow. So we're very much of the mindset that we need to be self-funding, and we'll do everything we can to enable us to achieve that.
Lovely. Thank you. And we look forward to hearing from you again in 6 months' time.
Look forward to it. Thank you.